I think it was a good decision yesterday. Two back-to-back 75 basis points hikes shows the market that Powell and the Federal Reserve is getting on top of the inflation surge in the United States. Now, what it does to GDP is going to be interesting. It's a bit of a, I heard Will talking about the technicalities of it. GDP, gross domestic product, but remember, in that calculation, you take the net trade impact. And if we get a negative quarter in Q2, it's going to be on the trade side of the economy. We have a very strong US dollar, and that slowed US exports and led to a surge in imports. So if that number goes negative in the Q2 result, my guess is it's going to be because of a deterioration on the trade account. Domestic demand, which is what everyone's really interested about in the United States, I think that's going to be pretty firm in Q2. So that's just the technicality to worry about there.
Really, you think the domestic demand is going to stay firm? Because there have been indications that the consumer is getting a little bit skittish.
Indeed, there have. But when you look at the data on bank accounts for households, and this includes low-income households, they're still holding a lot of money in their bank accounts ready to come back into the markets. And we've got what I think you have to call the full employment market, with companies out there bidding to get new staff on and offering bonuses and all of that. So I think these are sort of the temporary things you get when you move out of a decade of quantitative easing. It was bound to happen, and it's not too bad in my view.
We're going to see you talk about quantitative easing, we're going to see the tightening really kick in September, and no one's really talking about that these days. Is that going to make much of an impact?
It's already making an impact. I think this is why you're seeing crypto fall over, why you're seeing IPOs cancelled and all of that. There was a lot of easy, cheap money sitting on the table, which investors, whether they were households or corporates, were taking advantage of. That easy, cheap money is gone. And so some plans by households for buying things, houses, cars. Some plans by corporates for projects. They're being taken off the drawing board. That's the point we're at. And it's probably a good idea that those projects go off, those purchases go off the drawing boards. They were never that strong. They relied on money being freely available at incredibly low interest rates. That's not a sound way to run it. So I think we get through the second half of this year. Into 2023, we might have a soft recession, but you'll be in a good position to build that US economy back up into 2024, an election year, of course.